Hi, this is John Camarianos. Welcome to a new edition of Capital Considered. This will be slightly strange, but hopefully still an enjoyable experience for the viewer. We interviewed Meb Faber today. He's a rather famous investor, and due to my own technical difficulties, the video didn't come out as well as I would have liked. There was an echo in the background. But I discovered that if I removed my own audio and video, Meb's audio and video was just fine. So I've gone ahead and done that. I've removed all of my questions and I'm going to ask them now alone, and then I'll splice them into Meb's answers and we'll let his part of the interview stand. I think that will be reasonable enough. Meb gave us 45 minutes of his time and I don't want to pester him for more. And so let's see if this works doing it this way. Meb is the founder of Cambria Investment Management in Southern California, Manhattan Beach, just south of LA, a really lovely area of the country with which I am somewhat familiar and miss at this time of year since I used to live in California. He's famous for a number of different investment strategies. One is shareholder yield. So that's not just dividend investing, that's taking the dividends and adding what Meb calls net buybacks, because companies sort of simultaneously buy back shares, but also issue shares. So you want to take a net share buyback number, add it to the dividends, and come up with a shareholder yield number. And then Meb has a number of funds that pick stocks on that basis, shareholder yield. Meb is also famous for trend following, and he wrote an academic paper, I think in 2007, almost 20 years old. This paper kind of broke the internet. I think it's been downloaded nearly 200,000 times, one of the most downloaded academic papers. And he's sort of famous for that paper and also trend investing or trend following. The third is global value. Cambria has an ETF that invests in the countries with the lowest Shiller PE or CAPE ratios. And it's a lot of small emerging markets countries that lead the list on that fund right now, but it's beating the S&P 500 quite surprisingly for the last 1 and 3 year periods. And then last, Meb is famous for a series of funds that he's just issued. I think one is still in the process of coming out on what's called the 351 exchange. So this is a part of the tax code that allows an investor who has a tremendous amount of appreciation in a stock to put the stock into a diversified fund and not wash the gain away, but defer the gain, and in the process, getting out of the very concentrated position and getting in a diversified portfolio without paying taxes, at least at that moment of doing the exchange. The investor will have to pay taxes eventually when they sell the ETF or the diversified portfolio, but for the time being, the investor gets to get rid of their greatly appreciated stock without paying tax at the moment. So those are the topics we discussed, and I began by asking Meb about the famous paper that he wrote and about trend following. So hope you enjoyed the video, and you'll see me back again when it's time for me to ask the next question and for Meb to give his next answer. Thanks very much.
You know, it's almost hitting a 20-year anniversary of that paper. It's time to do an update. I'm getting old, but it's due 2026. It'll be on the to-do list. You know, that was my first academic paper, and the concept was trend following. The first title of the paper was actually called A Simple Approach to Market Timing. And if we know anything about investing, there's a lot of phrases that have a fair amount of baggage, like the CAPE ratio, and people brains shut down when they hear something like market timing. So this paper, we changed the title to A Quantitative Approach to Tactical Asset Allocation. It's a little bit of a word salad, but it was just a basic trend idea. Concept was, how can you reduce your risk, avoid these giant drawdowns in markets, and hopefully survive to play another day.
Here I asked Meb about trend following in general and how the concept can be used, how an investor can use it in their portfolio.
So when you talk about trend, it's kind of like saying dog. You know, there's all sorts of different dogs that are related, but a Dachshund looks nothing like a bulldog, which looks nothing like a Great Dane. And so the general precepts of trend is that you're trying to be long markets that are going up and either out or short markets that are going down. Sounds noble in theory, but the devil's in the details. And depending on how you apply it, so you could trade traditionally like a managed futures, which is 50 or 100 or 150 markets around the globe, long or short, currencies and commodities and all sorts of futures. Or you could do something a little simpler that might just say, hey, I want to invest in, some ETFs that represent large asset classes like US stocks or bonds or REITs. And really they can get quite a different exposure. Um, but we will say that we think to a traditional portfolio of US stocks and bonds, there's no more premier diversifier to that traditional portfolio than trend following. We're probably furthest out on this belief or view than anyone else in the country that's a professional advisor. And most people, when they allocate to trend, they say I put in 5, 10%. And we think a reasonable allocation, which we outline in our trendy portfolios ideas, could easily be up to 50%. The futures part is less important as the trying to own what's going up and trying to not own what's going down or shorting it. And the whole concept is, trend has traditionally a pretty low batting average, which makes it hard for a lot of people to implement. And if you end up with a Otani batting average on trend, that's probably pretty good. But the whole point of investing, and it rhymes a little bit with something like a venture capital, really power laws define all of the investing markets, is that a small number of big winners take care of all the little losers, and you want the losers to be little. And so what it is on any given year, it could be euro dollar, it could be cotton, it could be S&P, it could be oil, who knows, short the yen, on and on. But really, it's that global approach, risk management, position sizing, all these things that go in. The challenge with trend, buy and hold is great. We have buy and hold ETFs. Trend following is great. We have trend ETFs. But the problem with trend is you tend to look different than the rest of the world. And that's hard for a lot of people, and particularly this bull market we've had since 2009 has just been an absolute just face ripper, romping and stomping US stocks for 15 years. One of the best periods in history for US stocks, 15% a year. You get pretty rich pretty quick doing 15% a year, and here we are again, 15%. And so, if you did anything else, it probably hurt, and trend, would be in that category. So, I think the struggle for many people, trend usually, not always, does great during the really bad times, geopolitical macro events like 08, 09, 2000, 2003, COVID, on and on. That's usually where trend shines, but we haven't had one of the we haven't had one of those events in quite a little while. Yeah, 2022, that's pretty good. But really it's the combination of the two, buy and hold and trend, where I think the magic happens on sort of a yin yang sort of setup portfolio.
Here I asked Meb if, even though trend following funds did well in 2022 when both stocks and bonds did badly, bonds quite badly from a historical perspective, if investors were still asking, why do I own these funds? Because they haven't done particularly well in 2023, 2024, and most of this year. Here's his answer.
It's, being diversified means always having to say you're sorry. So no matter what, when you own a bunch of assets, there's always going to be something stinking it up. And the tough part for a lot of people is that S&P has been the very clear winner for, 15 years for many people is a lifetime in investing. It's a career. But it wasn't that long ago, 2000 decade, where the exact opposite happened, where S&P was one of the worst assets. But also, it's short memories, but also these regimes can last a long time. An example I was giving, I gave a speech the other week, and the announcer was talking about the starting of the NBA season, and they were interviewing NBA players, and they were asking all these players, "What do you remember about the '90s NBA?" And all the players had this blank look on their face, and they're like, "What are you talking about? I wasn't born yet. I was born in the 2000s." And so my point being here is that we can only most of us extrapolate from our lived experience. And for an investor that started investing post 2009, your lived experience is buy the dip. You buy stocks that go up no matter what. They may dip 10, 20%, but that's about it. And the generation before that learned, hey, look, these things can go down 50. Our grandparents' generation learned, hey, these things can go down 80 or 90. And in different countries around the world have learned similar sort of setups. So I think studying history is the number one thing investors can do, not just for trying to outperform, but just understanding expectations of what's possible and what can happen and often does.
Here, as we were discussing the S&P 500 and how well it's done lately, how many people have short memories and don't really remember anything but the S&P 500 doing extremely well. I pointed out that Meb's uh, Global Value Fund has done very well lately over the past 1 and 3 year periods, and got his response on that.
Yeah, it's funny with 20 funds, there's always something doing great and something doing terrible. So we love to joke about, and we actually like to talk about our funds that are doing poorly. So a number of years ago, not surprising, that fund was GVAL. And GVAL, for the listeners, goes and buys the cheapest stock markets in the world. So currently places like Singapore and Turkey and Poland and Brazil and Colombia, a whole bunch of basket of countries that nobody wants, right? But the PE, the 10-year PE ratio on that basket is darn near low teens or even around 10 versus the US, which is currently 40. So a Grand Canyon wide difference on valuations. And um, for a long time, this strategy of foreign stocks and value didn't keep up with the S&P. Nothing did really, but in particular. But here's the crazy, spooky statistic I gave the other week on TV around Halloween. I said very quietly, lost in the discussion and excitement about stocks at all-time highs, gold at all-time highs, Nvidia being a $5 trillion company. Very quietly, foreign stocks, in particular, foreign value stocks, have started to outperform. And I think no one is going to believe me, but you can go look up a chart of GVAL as a good proxy, is now outperforming the S&P over the last one, the last three, and the last 5 years. So there's been this, kind of explosive period, but nobody's really talking about it yet. And then you may see a sentiment shift at some point, but that's not today. And these type of regimes can last not just years, but better part of a decade too. So long forgotten foreign and emerging may people may start to get interested again at the end of the year. If you look at the long history of stock markets, a global portfolio has better risk-adjusted returns than the US. Diversification works. And I think most people are just conditioned to this period that we've had, which has been amazing in the US. But the starting point, and almost no one has this portfolio for the global market portfolio. If you look at stocks, US is two-thirds. So most Americans put in 80, 90, 100% in US stocks, but if you're a Vanguard indexer, you should put a third in foreign, and about of that third, let's call it 20% foreign developed, 10% emerging. No one does that. I think people are going to start to wake up if and when this outperformance continues.
Here, I asked Meb about how systematic GVAL was, how often they took an assessment of each country's CAPE ratio and then adjusted the portfolio accordingly.
Everything we do is systematic. We like to call it in-house indexing. And GVAL is one of our slow funds, meaning it only updates once a year. And when you're looking at sort of these deep value, you could actually update this fund probably every 2 or 3 years, and it's not going to matter much. Because if you're trading at a PE ratio of 8, that country needs to double or triple or quadruple to even get kind of out of the basket. And the same said differently, a country like the US or India needs to go down a lot or the earnings skyrocket for the valuation to become reasonable. So it updates every year, and usually there's only one or two or three countries that kind of come in or come out. Because usually what happens is, you're buying these countries often that are, it's the P and the PE that's moving. So usually they're down 50 or 70 or 80 or 90%. But the thing people assume is that it's always the same names on the cheap side and the same names on the expensive. But you can look to China as no better example of a country that's just gone from boom to bust to boom to bust on the valuation of their equity market. A couple years ago, China was arguably the cheapest it's ever been. Their stock market had gone nowhere in 30 years. That's my favorite thing to hear is an investment that's cheap, it's hated, nobody wants it, and then it's starting to get back in an uptrend. And so that happens but like if you look at even the UK, UK was one of the cheaper countries for a long time post Brexit. Nobody wanted it, still probably doesn't want it. But then all of a sudden you start to get some of these 20, 50, 70% returns and people start to take notice.
Here, I wondered out loud whether people would notice GVal's outperformance when it got to be too late, just when it was about to start to underperform again.
The joke that we gave to most investors recently is I said, look, for 15 we wrote a paper called the bear market and diversification, which was talking about how the S&P creamed any asset allocation. And I said most financial advisors, you sit down and over the past 10 years the client sits there with their printout and they say, explain to me why we own bonds, why do we own foreign, why do we own emerging markets, on and on. And we joke that by the end of this year they're going to have forgotten. They're going to say, excuse me, advisor, why don't we own emerging markets? Shouldn't we own a lot more of these other diversifying investments? But these things can change pretty quick for sure.
Here we left GVal behind, and I went on to ask Meb about his 351 exchange funds, how they operate, how they function.
Sure. A lot of people listening to this are probably saying, I hear you. I know US stocks are expensive. I got a bunch of NVIDIA, but I can't sell it. I'd love to move into small cap value or foreign or something else, but the tax man's going to kill me. And, the taxes have long dictated what people do with their money. And sometimes, it's detrimental. But it turns out, it sounds like an infomercial. Just wait, there's more. There's a solution for these type of situations. It's called a 351 ETF exchange. And we try the simplest example to give to investors is it's not too dissimilar from a 1031 exchange, which if you're familiar with is someone how people have made generational wealth over the past 100 years on real estate, where you buy a building or something and you own it for 30 years and you want to sell it, you can sell it, roll it into a different property, and it's not a taxable event. So you defer your taxes. You don't wash them, that'd be illegal, but you defer them. And so that's a very powerful thing. And so with stocks, you can now do that with ETFs. So 351 has been in the tax code longer than I've been alive, but it really didn't find its perfect spouse until the ETF structure came around. And so basically, the very quick summary is you can contribute property, so stocks or ETFs, publicly listed, no Dogecoin, no futures, no options, no mutual funds, no hedge funds, just public stocks and ETFs to the seeding of a new ETF, and you get the ETF in return. And it's not a taxable event. So for people with concentrated stock, with highly appreciated positions, with direct indexing, all these things, it's a potential solution. We've now done 3 of these. We're doing a 4th one in December. So if you're an advisor, you're an individual, and you're interested, you can reach out to us. If you go to Cambria Funds, there's a big old 351 tab that's got all sorts of materials and information and webinars and podcasts. We think it's one of the most interesting developments in the investing space as far as products in the past 20 years. No one knows about it yet. So the fact that you do is impressive because 99% of people I talk to have never heard of it, including some of the smartest investors in the world. So I think 2026, it'll start to go a little more mainstream. You got to remember that the S&P by itself has been a 10 bagger since 2009, and I think the Nasdaq's been like a 20 bagger. Forget Nvidia, that's like a 500 bagger. So yeah, there's a lot of investments that have gone up quite a bit, and people, I feel like they know US stock market's expensive. They know that it's concentrated, but they let their behavior be dictated a little too much by taxes. But now that you can solve for that problem, I think is really exciting.
Here I asked Meb about the mechanics of doing a 351 exchange. How should an investor go about it? Should they call their broker to see how they exchange their shares of appreciated stock into one of these funds? And also, what are the limits regarding those exchanges? How much of your portfolio can you exchange, etc.?
You got to reach out to us. There's two considerations that I will mention. So the number one is that the portfolio has to be diversified, meaning it can't just be one stock. So the largest position can't be above 25%. So you got 10 million NVIDIA, you either got to come up with 30 million something else or cut it back and maybe do 2 million NVIDIA and 8 million something else. But the cool part is ETFs are pass through. So you could theoretically give us 100% SPY because it looks through the underlying holdings. But we can walk you through that. And just reach out to us, or if you have an advisor, ask them to reach out to us. There's certain custodians that can't do it. You mentioned Fidelity, they can't do it. It's in the too hard pile for them. A lot of like plumbing and financial services, it's a lot of people struggle. It's very legacy business. Like you mentioned mutual funds earlier, the pipes on there. But my goodness, my this is my favorite time of year because Morningstar publishes some of the worst offenders on the capital gains from the mutual fund world. And I mean, some of these funds are paying out 20, 50. There's one that did 80% capital gain distribution. Imagine getting that in your Christmas stocking. I mean, what a depressing end of year present. It's like worse than coal. I'd rather have coal.
Here I asked Meb about what made this strategy more compelling in an ETF structure or wrapper than in a mutual fund wrapper.
Yeah, you just hit on the magic. The ETF structure and the reason we say the ETFs are eating the asset management industry is because they have this tax efficiency. And if you want to get philosophical and talk regulatory, it's crazy that mutual funds can't adopt the same structure in my mind. But hey, look, I'm an ETF issuer, so I don't care. But on average, I feel like it should be universal. And you're kind of seeing a workaround potentially next year with mutual funds being able to offer ETFs as a share class. We'll see, but it definitely doesn't seem fair that ETFs are get to be this Cinderella. But we'll take it while it lasts.
At this point, I asked Meb about the composition of his 351 funds. What are investors getting when they exchange their greatly appreciated stock?
So we laid out a buffet when we decided to do this last year, where we said, here's going to be four strategies we're going to launch. You can opt in, pick the one you want, because I didn't know. I mean, me personally, if I had a bunch of Mag 7 or highly appreciated US stocks, I wouldn't just want to swap it out for more US stocks, right? I would want something different. So the first fund we did was like a value approach US stocks. That was the ticker symbol TAX. The next one we did was a diversified portfolio, so it's an endowments trial. That's ENDW, raised over 100 million. So that's for someone who said, look, I want to be a diversified allocation. Then we did the last one was a global stock fund. So meaning, hey, I want roughly the top 500 stocks in the world, not just US, but elsewhere. That's actually interesting because that fund doesn't really exist elsewhere in the ETF landscape. And we launched it for 25 basis points, 0.25%. I think if you and I do this conversation or 5 years from now, I wouldn't be surprised if that's a 10 or $50 billion fund. We're pretty excited about that one. And then the one we're doing next month is a US fund, but it's not market cap weighted. So it's something that looks like a equal weight style fund. And then next year we'll lay out a timeline for a few other interesting ideas. That's kind of the been the buffet because we weren't sure, and oddly, one of the things is that people still want S&P. And I say, you guys, I cannot do that. I cannot bring myself to launch an S&P strategy trading at a CAPE ratio of 40 at this point in the cycle. I just can't do it to take all this in and then watch it go down 50%. But to those that want it, God bless them. Maybe it'll keep going up and get as expensive as Japan was in the 80s. I don't know. But that was kind of our buffet. And next year we'll add some more.
Here I asked Meb about what the Schiller PE or what the CAPE ratio is. And as you'll hear, he was worried that we might lose viewers if he defines it, but I wanted him to do that since we'd been talking about it so much throughout the video.
If we haven't lost everyone, we're going to lose them now. CAPE ratio, I feel like, is one of the least understood ideas in investing. It's nothing more simple. It goes back to the time of Ben Graham, where he was like, let's come up with a PE ratio. Let's smooth it across the business cycle. He said 7 years, but Nobel laureate Professor Schiller said, let's try it across 10. You can bring it back up for 100 years or so. And what you find is that On average, it trades around 18. If inflation is mellow, low 20s. And this is true for all the other countries in the world. But the US has traded as low as 5 before and as high as 45 at the peak of the internet bubble in 99. So my favorite bubble. And usually, on average, paying up for all the future cash flows, you paying a really high level is not a great idea, and paying a little low level is a great idea. And so the US being at 40, which is now the second highest ever, so it took out 2021. But what we found, so we built this for all the other countries in the world. So if you go to the Idea Farm, and that's our research site, we track it for 45 countries. And we find that if a country ends the year at 40 PE or above, which is rare, but it's happened, on average, the future 10-year returns after inflation are roughly zero. So not that exciting come around 2035 when you have me back on the show. But what's even more interesting is the batting average is zero. So not once ever that we can find has a country ended the year at 40 and the future 10 years been above average. We know anything about markets, anything can happen. It could keep going up. A part of me wants to see it take out the 99 highs just to say that I lived through it again. But on average, it's the good news is the rest of the world is reasonable, trading around the high teens. But as we mentioned with GVAL, there's a whole slew of countries that are just screaming cheap. And so it doesn't have to revert, but on average, you want the lower valuation countries. And to be clear, the thing about valuation, it's a very kind of rough tool, but what we say is every single valuation metric you can come up with, when a country is really expensive, and I only use the word bubble when it goes above 40. Okay, so when it was 20s and 30s, I would just say simply it's on average more expensive, no big deal. Um, but every valuation metric, it could be 1 year PE, forward PE, backward PE, price to sales, price to cash flow, Tobin's Q, Buffett's indicator, market cap to GDP. They should all say the same thing, and they do. Ditto for a country that's screaming cheap. They should all say the same thing. And so in the Idea Farm, we actually use 4 or 5 different 10-year valuation metrics, and on average, they all rhyme.
At this point, finally, I asked Meb to talk about the concept of shareholder yield, dividends plus net buybacks. And of course, he's wearing the baseball cap with the ticker of one of his first shareholder yield fund.
Yeah, listeners, and you like this hat, let us know. We'll send you one. The concept is nothing new, but as it is with markets, we often say, people like to say this time is different, or has there been a real structural shift? And often there isn't, but sometimes there is. And one of the biggest ones that's happened in the past century has been a transition of the way companies distribute their cash flow to shareholders. And it's been a good transition and a smart idea adopted in the US and now moving around the world, which was simply if you look at buybacks, stock buybacks versus cash dividends, again, this is even worse than CAPE ratio. They're the number one, they're the exact same thing. When if a stock's trading at intrinsic value, and nobody understands this more than the GOAT, Warren Buffett. He's been writing about buybacks in almost every letter for like 40 years. And so a lot of people didn't notice, but starting in the 90s, companies started buying back more shares than they did and paying out in cash dividends. The dividend yield on the S&P is 1.15%, which is knocking on the all-time low of 1.1%, which is crazy. But part of that is because they've shifted to buybacks, which if you reframe them as flexible dividends or tax efficient dividends, your brain usually works a little better. We have a whole chapter in our updated book about myths around stock buybacks. The whole point I'm trying to make is that you need to incorporate this when you're selecting stocks. And let me give you a reason example why. Um, it's not just the stock buyback part, it's also the share issuance. So if you live in my home state of California and you go up the road to San Francisco, a lot of these tech companies just issue a ton of stock-based compensation to the C-suite and founders. And that's a huge dilution. Nobody understood this more than Munger, where you talk about looking for the cannibals, the companies eating their share count as opposed to expanding it, because dilution is a huge negative influence on stock returns over time. So if you combine the two, cash dividends plus net stock buybacks, it gives you a much more holistic approach. And we think when you screen historically for stocks, the past 100 years, you end up with much better companies, high cash flow companies, companies that are high quality and can sustain if and when we ever have another sideways or down bear market.
Here I mentioned that I thought share buybacks had been illegal until the early 1980s, and Meb corrected me. It was as animated as he had become in this interview.
This is one of my myths. And so I got to send you an updated copy of the book. It's actually been legal forever. It has just been more widely adopted. And so I actually have, if I was doing this in my podcast studio, I got a book. I think it's Charlie Ellis. I'm trying to remember who wrote it, but it's from like the 1970s, and it's talking about the entire book is about stock buybacks. And so I think I called it share repurchases or something else. It didn't really hit the mainstream until the 80s. There was a rule that was passed that kind of, gave the CEOs more comfort on um, having safe harbor from buying back their shares. So I think it's the interpretation of legal, not legal, but they've always been around because if you think about it, companies changing their share count for last 100 years. But the 99% of the disdain for buybacks is actually misdirected because what people are upset about is the share issuance. So if you're a tech company and what they're peeved about is the CEO paying himself $1 zillion and they use buybacks to mop that up. So that's why the net stock buybacks is so important because if you could have a dividend stock paying 4% yield, you're like, oh my gosh, I got this amazing dividend company. And let's say the company's issuing 4% a year in shares and they're not buying back any, you have a 0% yielding stock. And a lot of people don't know that. You can even have negative yielding stocks. So the whole point of this is that you need to understand the capital allocation. One of my favorite books on this, The Outsiders, and make sure you're not investing in companies that are just doing buybacks to mop up the share issuance. So that's why the net number really matters. No one understood this more than Apple. We owned Apple in our shareholder yield fund from I think 2013 to 2020, but they did both. They did dividends, they did net stock buybacks. Eventually, we sold it because it got too expensive. But screening for the net buybacks is the important part because you kick out the people that are just serial share issuers, and that's a board issue. That has less to do with kind of what we think about the company.
Here I asked Meb about the danger of CEOs or corporate executives buying back stock when the stock is too expensive, and who made a reference to Warren Buffett, who has his own rule about when he buys back Berkshire Hathaway stock, how cheap it has to be.
Not that high. It's like 1.3, but he's been, not surprisingly, it's not near that now. It's up around 2, I think, last I checked, and he's sitting on a whole slug of T-bills and other things. But that's a great point because the last thing you want is a megalomaniac CEO who just thinks his stock's always cheap and buying it back. So what we do is kind of what Buffett does. We have an objective measure where we're screening for the companies to be on average cheap. Now, I will say, and this was an interesting study when I first read it probably 10 years ago, on average, if you bucket the companies issuing shares, buying back shares, and buying back a lot of shares, it turns out on average, the share issuers are highly valued. The buybacks are cheaper, and the big buybacks are even cheaper. So on aggregate, they kind of get it right. But you still need to test because I mean, look, Meta issuing a bunch of debt and buying back shares. Why are you doing both of these things? It makes no sense. And some of these companies doing it, trading it, I don't know, 50, 100 times revenue, not earnings, revenue. We don't want to invest in those. And so if you actually look at our shareholder yield ETF, very low tech exposure. And so people will come to me and they'll say, Mab, well, you don't get it. You're an old fuddy-duddy like Buffett. You don't get value because you're never going to invest in tech companies. And I say the funny thing is, it's not the approach because in our emerging market fund, tech has been the number one or number two biggest sector. So it's not just value not being interested in tech, it's value not interested in tech in the US currently for a whole host of reasons. On average, a lot of the tech companies are expensive and they don't treat their shareholders well.
Here I asked Meb how he got started in the investment business, and it led to an interesting discussion about just the importance of surviving. I think he said when when it's all said and done, you're not going to be sorry you made 8% instead of 9%. You're going to be happy if you survived. And that's really the important thing in investing.
A know nothing 20-year-old, and the decisions we make when we're 28, I guess. I don't know. I didn't have anything better to do. Was a ski bum up in Lake Tahoe and moved to LA for a year and just assumed I would hate LA and it'd be full of vampires and soulless people and, kind of is. But the beach is pretty nice. And, one year became two. And we often tell people that the biggest compliment you can give them in the world of investing, but also just life in general, companies, entrepreneurs, startups, is that you survived. And this applies to portfolios too. Everyone's always obsessing over return. How can I squeeze out a little bit extra return? And I often tell people, say, look, when you're reviewing your portfolio, when you're 80 or 90 or 120 years old and you look back, the question is not being like, man, did I really do 9% instead of 8? It's going to be, did I do 8 or 9 versus 0? Because I got taken out of the game because I was buying 3 times leverage Nvidia and 0-day options and YOLOing into prediction markets and everything else, fart coin and all the gamification of markets today. And so I think that's true with the company. We've been very risk averse and just want to make sure we're here because I have a lot of friends and I do a lot of angel investing. And, if you know anything about entrepreneurship, is that most companies go the way of the graveyard, and so we want to make sure we stick around, and hopefully the alpha will take care of itself at that point.
Here we asked Meb for his final thoughts, and he noted that U.S. investors probably have too much U.S. stock exposure. They should start looking overseas, maybe get more value exposure, maybe have more hard asset exposure, and if you're up to it, maybe look at a trend following fund.
Oh man, there's so many things to talk about. I think if you look at the world today and you look at most investor portfolios, I'll leave them with this. Most U.S. investors, they have this big home country bias. They put everything in the U.S., stocks and bonds, and then it's market cap weighted. So if I were to tell people to do a couple things, the first step would be to break that market cap link in the US, maybe tilt towards a little bit of value. Definitely try to get some foreign exposure. Most US investors often have very little real assets. So things like REITs, real estate, tips, commodities, and commodity equities. You could explore trend following, but that's a little bit of a philosophical departure for many people. And then if you're stuck in these big tax situations, reach out. We're happy to walk you through the 351 ETF exchange too. Thanks for inviting me, bud, and let's do it again.
At this point, we signed off. I just wanted to say thanks to Meb Faber. Thank you for your time, Meb. I hope it worked out, this way of splicing it together, given all my technical difficulties. No fault of yours at all. And thank you, viewer, for watching. I hope it worked for you as well. Please click like and subscribe. Thank you.
No information on this podcast should be construed as investment, tax, or legal advice. This podcast is not an offer for advisory services or to buy or sell securities. Before making any financial decisions, consult with a qualified professional advisor who can assess your individual needs and circumstances. Past performance is not indicative of future results, and all investments carry risks, including the potential loss of principal. Securities discussed in this podcast may be holdings of the host or his clients.